Welcome to the latest Motley Fool scoreboard. I'm Anand Chakabaloo. We've got longtime fools Travis Hoyam and Jose Najarro giving a 1 to 10 rating to HR and Finance SaaS company Workday, ticker symbol WDAY. As always, we'll do a 10-second bull bear. We'll rate Workday's business, its management, and its financials. We'll talk valuation, and if there's time, fools, we'll play Armchair CEO, and we will top it all in about 12 minutes or less. So let's get to it. Jose, tell us more about Workday.
So for Workday, the bull case here would be that Workday is in a leading position in cloud-based HR and financial management software with a strong customer base among some huge enterprises, and they are seeing a nice amount of consistent revenue growth. And they are expanding into markets like the healthcare and finance, which they believe have huge TAMs. Now, the bear case here is it has intense competition in the enterprise software space, and the company struggles to achieve consistent profits. Also, as we're going to see later on throughout this episode, stock-based compensation is going to be a very touchy topic.
All right, Travis, let's rate the strength of Workday's business. A 10 is invincible, a 1 is hopeless.
There's nothing invincible in SaaS software and enterprise software, but this gets pretty close because they've got, I think, kind of the go-to solution. Management team came from, or the original management team came from PeopleSoft. I used that way back in the day in my 3M days. So that was an interesting backstory. Basically, that software wasn't going the right direction and moving fast enough, ended up under Oracle, and they said, hey, why don't we start this solution that's going to be a little bit more for the future? They've obviously built that phenomenal growth and really growing into the market. As you know, like you said, like Jose said, they're getting into a bunch of huge players, and you pick off companies with 100,000, 250,000 workers. Suddenly those are really big numbers coming in. We'll get to the financials though. I think that's where, the questions come in. But what do you think, Jose?
Yeah, for me, I would give this a 7. Like we talked about, pretty much like you mentioned, Travis, right? In the SaaS space, there's really no invincibility here, but they are a nice leader in this kind of cloud-based HR and kind of financial management software. So that's always great to hear, and it kind of is backed up with that strong revenue growth. To me, one of the things that I would be excited here for Workday is just the large market opportunities in things like financials, like I mentioned in the bullish case, where they only have roughly about 30% have moved to cloud, to kind of the cloud space in the financial world, and in the healthcare market, which has such a huge TAM, is even lower. So there's definitely a lot of opportunity here. And as a leader with that consistent revenue growth, I give it a 7.
Management time. Travis, a 10 is Warren Buffett, a 1 is Homer Simpson.
I gave management a 5. Carl Eschenbach, if I'm saying that correctly, is the CEO. It came to the board in 2018 and taking over for the founders, the co-founders who have, I think, kind of moved more to a retirement phase of their career. So it's a little bit TBD, on what his direction for the company has been. If we were grading the founders and growing the business from nothing to what it is today, I would give a much higher score. But that's why I kind of middle of the road here, because I think there's a lot of questions to be answered. Things like stock-based compensation, can operating margins continue to move a little bit higher? Are those expansions that Jose is talking about going to be the right moves, and is that going to be additive to the business? We will see, but probably better to grade them on maybe a 3 or 4 year basis in the future.
Yeah, so for me, for management, I will give this one a 6. I think we just are coming back off from the CVS episode. And the CVS episode, we talked about lack of creativity. I think that's what management has, at least here. Obviously, that creativity does not mean will be the right answer, but at least it showcases that management has some form of direction. And the company recently had their investor day where they did talk about some of their financial growth opportunities, a nice revenue growth in the upcoming years. More importantly, they are executing in an AI strategy and product innovation. Obviously, AI is super popular right now. Again, it just kind of showcases the creativity. Now, if that creativity is the right move, we're going to have to play out and see. But another thing that management is doing well is kind of doing those international market growth, which, again, can be a great move for this player.
Financials, Travis, a 10 is a fortress, a 1 is yikes.
This one's a little bit tough to look at because this is a SaaS company. As you would expect, gross margins are extremely high, about 75% gross margins, but that does not translate into profitability long term. Now, there's I believe it was a tax benefit a couple of quarters ago that kind of make the trailing 12-month numbers a little bit skewed. But right now, on a quarterly basis, we're looking at an operating net margin, an operating margin of about 5%. So I would like to see that be much higher. The other thing is stock-based compensation, 18% of revenue right now. That is incredibly high. Now, that doesn't seem to be particularly dilutive because the stock is trading for 7.5 times sales. But if you're going to give away 18% of your revenue in stock-based compensation as part of that operating expenses, that's going to ultimately dilute shareholders. So I think that's what I would like to see is those operating margins. If you're the go-to piece of software and you're a SaaS piece of software with very high margins, gross margins, you should be much, much more profitable as you kind of win the whole market and growth starts to slow down, which it is today. So that's why I only gave it a 4 on the financial side.
Yeah, and here I gave it a little bit higher. I gave it a 6, but the main reason I dropped those 4 points are exactly what Travis mentioned. I put stock-based compensation is roughly 1/5 of total revenue, and Travis gave us the better answer, about 18%. The reason I also gave it a little bit higher is one thing I do like to see is kind of a strong cash and short-term investment versus low debt, and we did see about 7.3 billion in cash and short-term investments and only about 2.9 or 3 billion in long-term debt. So with that strong revenue growth, this is what I'd like to see in a growth play. Strong revenue growth, a lot more cash than short-term investment. Unfortunately, on the downside, we did see that huge amount of stock-based compensation in regards to revenue.
All right, let's move on to valuation, Jose. Our quant team rates Workday as moderate on the cautious, moderate, aggressive risk-reward spectrum. How well will Workday's stock do over the next 5 years? And how safe is it, keeping in mind a 10 is a sure thing and a 1 is a lottery ticket?
Yeah, I mean, I think if management continues to do what it's doing and focusing on some creativity moves, especially with things like AI and the way the world is moving, I think in 5 to 10 is potential annual returns over the next 5 years. Now, in forms of safety, I'm going to give it a 6. The reason I give it a 6 is, just as we mentioned, this is competitive. You are investing in growth. Even though your balance sheet is strong, you still have a nice amount of stock-based compensation. So again, coming back to the stock-based compensation and kind of the growth story, I'm going to give it a little bit less safety rating and gave it a 6 out of 10.
Yeah, and I went kind of middle of the road from a return perspective, 5 to 10%, and said safety of 5. The real reason behind that is the things that we've been talking about, those operating expenses, stock-based compensation. Growth is starting to slow, 17% compound annual growth rate over the last 3 years. So not quite the same growth that it had a few years ago. I would also just generally worry about margin compression. You know, the margin expansion over the past couple of years has been a real boon for a lot of these SaaS companies. But what if we go through another phase where it's a 2023 again, where, you know, multiples come down from 7.5 times sales to 3 times sales? That's a huge drop in the stock, even if the operations don't change at all, just market sentiment. So those are the reasons that I would be a little bit more cautious with the stock.
In the interest of time, we'll skip armchair CEO and go straight to top it. Jose, is there a company in Workday's space you like more?
Here in this space, I wouldn't say there's many players that I would choose. I mean, like I mentioned, I like the growth opportunity here. I like their balance sheet. So I'm going to stay here with Workday at the moment.
Yeah, and I'll just pick one of the big names. I think you've either got to go really big or really niche in this market. So a company like Oracle, PeopleSoft, that still exists. Just a company bought back a ton of stock over the last decade. So set it and forget it with a company like Oracle.
Thanks to both Travis and Jose. They've given Workday an overall score of just 5.7 out of 10, despite an underlying business that scored 7.5. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is AutoZone. Till then, Fool on. No need to take up a bunch of time telling people we've given them a bunch of time.